Just to give you a quick note, yeah, I've published 16 books. I think 11 of them have been #1 in their categories on Amazon. I blog almost every day at newtraderu.com, and my priority in trading is managing my risk to maximize my profits. I always attempt to be on the right side of the trend, and when I'm wrong, I have a small loss. I really created New Trader U and my social media platforms to help new investors and traders navigate the stock market and avoid a lot of the mistakes that I had over the years when I first got started. Um, trying to give new traders and new investors a shortcut in the learning about the stock market. I really focus on the stock market as my #1 market for activity in. I do also use options at times in the stock market, and I have successfully navigated the stock market for 20 years. I've had great years. I think half of my years I've had over 20% returns in the stock market. And I was trading back in the 90s. I was started investing in mutual funds, and I've grown capital and expanded my means for over 20 years. Let's see. Trading methods. The biggest thing I see in my network and the traders that are a part of my community are they try to find the right niche for them, and it gets confusing because there's so many different methods out there for trading and making money. There's so much information, they get confused. What I try to do on my
Hello?
platform is aggregate the knowledge into making it easy to understand. If you're entering the stock market, there's many different trading methods, and all of these methods can make you money if you have a system and you have an edge. The default setting that most people, you'll hear your friends and family and in the stock market, is buy and hold investing. They believe you buy and hold the market, and over long periods of time it goes up, which is true, but you can be starting to be a buy and hold investor at the wrong time, and you can spend 10 years making no money. And at the same time, when you're a buy and hold investor, if you're using mutual funds, you're rewarding the mutual fund managers with fees no matter what the market does, while you're taking all the risk and you're holding no matter what, while really the people making the big money are the mutual fund companies. The indexes, stock market index, are designed to go up over long periods of time because they have underlying businesses that are all geared to make money regardless. So the principles of buy and hold investing, they could work on a 20-year time frame, but at the same time you can have major losses and you have no exit strategy, and you're just buying and really hoping over long periods of time. There's much better ways to participate in the stock market than buy and hold investing. And there's simple moving average systems that can really beat buy and hold investing. Another way is trend following. Pure trend following is really diversified management of futures. Futures give you leverage, and with futures you can diversify across up to 20 different markets with small position sizes with leverage, and you would make money when one of your markets trends tremendously. So pure trend following is the first diversified futures trading through a vast majority of markets, interest rates, commodities, currencies, stock indexes as well. But that's trend following. Trend trading is what Dan Zanger does, what Nicholas Darvis did, what Jesse Livermore did. It's William O'Neill, Can Slim investing. It's trend trading is when you're just trying to buy stocks and indexes as they're going up in a trend. Trend trading is just purely capturing a trend. A lot of trend trading uses short-term moving averages like a 10-day EMA or a 21-day EMA to capture trends. Swing trading is more of what I do. Swing trading is when a market is either going up or sideways, and you're buying dips, you're buying fear, and you're selling greed. Swing trading is when everyone's panicked and the Dow's down 1,000 points in the morning, and you're going in and buying, anticipating a reversion back to the mean of price. So swing trading, some people do short in a downtrend, and on a rally they will short on the way back up. But for me, the best way to swing trade in the stock market is buying dips. And sometimes the market has wide swings where you can buy a 50-day dip or even a 200-day dip, and it has narrow swings where you can buy a 10-day EMA dip. And swing trading can also be defined as support and resistance, where you're buying a resistance, or you're buying a support level on pullback. Day trading is when you actually sit at your screen 6, 7, 8 hours a day for most people. Most day traders trade the entire market. Stock traders would trade the open to the close, like 8:30 to 3. Day trading is when you have a lot of screen time, you're trying to catch very small moves. Usually you have to trade large position sizes because the moves you're trying to get are so small. Day traders go out of the day flat with no positions. Option buyers are buying contracts with limited time, trying to make money through the leverage options provide by catching a move in a direction. Options trading can be very profitable with large percent gains when you're on the right side of a trend. Options buying is more difficult when volatility is high because options are more expensive. Selling option premium are people that sell options when volatility is high to get maximum premium. And selling options, buying options is a low probability win rate for most times, but selling option premium is usually a high probability win rate. The key to buying options, is not to trade them too big when you buy them, and selling options is not to sell too many. So if you're wrong, you lose a lot of money. Selling option premium, I would not advise unless you have a hedge. But that's 7 different types of trading methods. I think before you start participating in the markets or wherever you're at in your journey, you have to pick which ones you're going to participate in. And you could even diversify and have like a swing trading system and a trend trading system to help diversify your trading, so you can make money in different kinds of markets. Most of these methods only make money in specific market environments. Buy and hold investing is for bull markets. Trend following makes money during trends. Trend trading is you have to be in the right markets that are trending. Swing trading, you need a range-bound market or an uptrend for the most part. Day trading, you have to have volatility during the day to make money. You have to have a big enough move during market hours because you're missing the gaps in the open and the close. Buying options, you need low volatility and cheap options. Selling option premium, you need volatility to be able to sell expensive options. So those are the 7 different methods that we all have to choose before we participate in the market. A trading plan. Before we can really start putting real money at risk, we've got to have a plan before we go into the market. You can't really make a plan until you've done back searching, back testing, chart studies, and you understand price history. You've got to have historical parameters before you can even start creating a trading plan. You have to have an edge. You've got to see what has worked in the past in different market environments. You have to have a watch list. You have to decide exactly what markets you're going to trade. A lot of traders get in trouble when they go to trade and then they see another market moving that's not on their watch list, and they go participate in another market when they really have no parameters or historical data to know what they're trading. Like I don't trade anything unless I have back tested and studied historical charts of a market, because different markets act differently. Forex and currency markets act differently than stock markets. Every market has its own rhythm and its own historical patterns. So nothing should be on your watch list unless you've done your homework. Your risk-reward ratio. When you enter a trade, you have wherever you have your stop loss at, that's your risk. Whatever your position size is versus your stop losses is the size of your risk. Your reward could be open-ended if you're using a trailing stop, or it could be a profit target. But before you enter a trade, you have to know where your risk lies, how much you would lose if you're wrong, and how much you'll make if you're right. And to see if it's even worth the trade. You may be risking $3 to make $1, and it's not worth the risk. Your stop needs to be tighter than your open side reward. Position sizing. You really have to start where your stop loss is going to be and work your way back to position sizing. Your position sizing should be based on how much you would lose if your stop is hit. You have to already know that number before you enter. Entering a trade has to be a quantified signal. A signal is something, a reason you would enter. You would say, if this market breaks out over $100, I'm going to buy at $101. That could be your signal for entering, because in the past, when a certain stock is broken out, you may see it's run 10% in price. So that'd be your signal before you enter a trade. You should enter a trade unless you have an absolute valid reason to enter it and a signal. Exiting a trade, there's different ways to exit a trade. If you have a winning trade, you're trying to exit with the most profit as possible. An exit could be a profit target that gets hit, or it could be a trailing stop. If your trade starts winning, you could say you're going to hold it until it closes under the 5-day exponential moving average. So your exit would be when it finally pulls back. That's one way to maximize a winning trade. The other way to exit a trade is, of course, you get your stop loss hit. You say, I bought it 100. If it goes under 99, I'm going to exit, or whatever it be for the volatility. But you would exit if you lose as much as you're willing to lose. There's also a time stop where you've held a trade for too many days and it hasn't gone anywhere, and you want to just exit because you've wasted too much time on it and want to move on to something that actually is moving. Your stop placement, the stop loss, you place your stop at the place price would go to show you're wrong. If you bought a stock at $100 a share and your target's 110, but you think, well, if it goes under 97, that was the near-term support, and that means the breakout failed. So you would place your stop under the $97. That would be where you're proven wrong, is where your stop placement should be. You should have an uncle point where your entry was invalid. A profit target could be a round number. It could be old resistance. It could be the most you think you can get out of it, where the risk reward starts skewing against you, where you're up 15%. And the odds are that's as far as it's going to go based on the historical moves. Trading time frames. This is where some people get in trouble, where they want to be a trend follower, but then they keep looking at the daily chart, or even looking at the ticker, live tickers. If you're a day trader, yes, you trade for whatever time frame you trade during the daytime. But if you're a swing trader, there's no reason to look at the chart every minute. You can actually go have a life and choose to use open market data or the closing market data to make decisions on. So you don't need the entire intraday action. I think we'll have to decide how much screen time we're actually going to have. A trend follower might be end of day data only. A swing trader might be the trade the first hour and the last 30 minutes, maybe looking at lunchtime. But we shouldn't be spending more screen time than is adding value to our trading. Sometimes more screen time actually hurts us and causes more stress for no reason. So we need to trade inside our time frame and not go down to too low of a time frame to try to get a swing trade for 5 days, but then end up looking at the 5-minute chart. It's counterproductive. Performance review. If we really have an edge and we've done our homework, we should see profits over a period of time. But there are losing streaks and there are drawdowns, but we have to continue to look at our performance review to see if what we're doing is working and making us money, and see if there's any errors we've been committing. So a performance review is crucial, and a lot of people also do trading journaling, where you actually are teaching yourself about your psychology when you journal, when you make mistakes, when you enter too big, you exit too soon, or you do something spontaneous. It's important to have a performance review to see if you're making any psychological or emotional errors, or even ego errors where we don't want to admit that a trade's not going to work out. But those are the 10 components of a trading plan. Here's a chart of the S&P 500 ETF SPY. This is my main system that I use. This is a chart of most of 2016. If you see these big arrows at the very top, this is the RSI, the Relative Strength Index. It generally, for the S&P 500, it stays within 30 to 70 on the RSI. This is an oscillator. Usually the price will drive the RSI down to 30 at the lowest intraday generally. this is one of my favorite entries in the S&P 500. This is something I will trade with some size, and I will use just a straight SPY S&P 500 to trade it with. If you see, generally it bounces at these levels. The MACD, moving average convergence divergence, down at the bottom, it's actually a measurement of moving averages themselves. When the signal line, the black signal line, crosses over the red line, it triggers a lot of good entries for swing trades on the long side. If you look at the moves, what I like to do, if I enter on a MACD crossover or a 30 RSI, I'll use it when the oscillator gets back close to the 70 RSI is when I'll exit. Whenever the moves go all the way up to the 70 RSI, that's generally where the risk-reward ratio no longer favors long positions. I like to lock in profits. The S&P 500 is one of the most stable things that we can trade. It's 500 of the strongest companies, and it's a system in itself, because the S&P 500 index, it brings in winning companies that are trending up and are large, and it takes companies out when they become weak and start declining in price. The S&P 500 is actually a chosen 500 companies, so you know you're going to get the strongest companies, and the strongest companies tend to always come back and bounce historically over a long-term period of time. You can apply some leverage to this system and make a lot of money. And it's a very smooth moving asset class. I was going to show everybody an example of a simple trend following system, really quantified data to see how they work. The system parameters for what I'm about to show you is it's the QQQ ETF, the tech, using the 250-day exponential moving average as an end-of-day buy-sell indicator from January 2000 to March 2017. At close, the system will be long the QQQ ETF when price crosses over the 250-day EMA, and will exit and go to cash if price crosses back under the 250-day EMA. This is a long-only system. Now, this is going to show you what the tech sector did from the top of the internet bubble until this month. And it's an actual using a 250-day moving average as your signal line versus just a buy and hold. This is the ETFreplay.com that I use. Here's our parameters. We're going to back test. Going to wait for the first cross before it goes long. Here's the dates. So here's our backtest statistics, it could be shocking to some people. We had 76% losing trades and only 24% winning trades. But our median win was 16.2%, 25% gain, while our median loss was a 1.3% loss. So it's a huge wins and very small losses on average with the 250-day. Our backtest result returned a 218.5% return over the time of the test, while the Qs that are measured from the first signal we got only returned 82.6% over the time of this backtest. So buy and holders during the time of the first signal for the backtest would have returned 82.6% by holding through the whole duration of this time, while the 250-day moving average backtest system made 218%. So you can see that during this time frame, you would have tripled your money in this particular system over this time frame. The average days in a winning trade was 223 days. Average days in a losing trade was 9. We had 2 consecutive winning trades was the maximum, and 9 losing trades in a row. That's where the drawdown would have came in, where we get by the 250-day break, and then we get stopped out. We buy the 250-day break, then we get stopped out. And that happened a lot in the S&P 500 over the last couple of years with a 200-day moving average system, where it doesn't trend. It just keeps floating around the long-term moving average. But the great thing about this system is in 16-year test, the maximum drawdown was only 23.7%. That's incredible for a 218% return. While buy and hold had an 82.6% return, but it also had an 83% drawdown, which is mainly because of I'm sure the tech sector meltdown we'll see. And of course, the 2008 was another meltdown. But this is a very simple system. You'll see the numbers on something this simple to crush crush buy and hold. Moving averages can be buy and hold so significantly. Buy and holders are exposing themselves to a lot of risk. And you don't need a huge winning system. Trend following systems really are profitable based on really large wins. Here's the Q's price action on top here, and this is a 250-day moving average. You can see here it took people in the system out of the equities during the complete bubble meltdown, and it got them back in. It got chopped around some for several years. Down here, the equity curve, but the beauty of this system and trend following is you would not have lost money during the bubble meltdown. The maximum drawdown was during the 2008 plunge, but even then the equity curve stays very smooth. So this is a system that you could have had as part of your trading for the entire time period with very little drawdown, and eventually you would have tripled your money as the market picked back up in 2010, 2013, even 2016 now. You would have been long above the 250-day moving average. It's a long-only system, though. It doesn't have you shorting below it, which a short side system would have done well in the bubble pod, but it would have just created more chop during the years when it was building a base. But this is not meant to be a holy grail or, this is just an example of a long-term trend following system. There's many different trend following systems. I have one of my books, How to Beat Buy and Hold Investing. I have 5 moving average systems that beat buy and hold investing over the last 17 years. But this is just an example. I mean, this is something the principles of this you can think about even if you're using a day trading system, a Forex system, swing trading system where you want to see the data. So here's the actual data for when you're buying and selling in the 250-day at QQQ. See the wins, it really gets you back on the right side during bull market upswings, and the losses are all kept very small. You can stay inside of bull markets for even 300 days when you're winning. The wins are very nice. Losses are kept small. And currently, this system is still in a trade with a 23.65% win right now. So that's just some interesting data to think about when you can fully quantify a system historically over 17 years. And it's not really the magic of a system, it's the fact that you're capping your losses and you're maximizing your wins in a trend following system. I mean, there's thousands of trend following systems that make money. It's a matter of being the discipline to follow them and to make them with the right principles. Everybody, family and friends could think you're a gambler. That's what I've heard my entire life, is everybody's shocked to think I'm just out here, gambling large amounts of money and it's all random. But, in trading, they think 90% of people lose money and 10% make money. But who are the 10% making the money then? If 90% are losing it, and contract markets are a zero-sum game, every time somebody loses money, somebody's making it. During the internet bubble, people walked away millionaires, sold their holdings, and while other people took the bath in the internet bubble going down. In Taleb, he asked a class. He was a famous money manager. He wrote some great books. He asked the class, "What is the best way to make money on gambling?" And he had no one to say, "Own a casino." Everyone was trying to figure out a way to make money as a gambler. And there are very few professional gamblers that make money. Even the ones that do make money as professional gamblers, generally they have an edge over a game like poker, or like Ed Thorpe had an edge on blackjack, mainly through betting and odds and card counting. But the vast amount of money in gambling is made by the casino operators, not the gamblers. So the casino paradigm, it tells you that you want to operate like a casino. A casino operates as a business. in your trading should be operated like a trading business, where you're buying assets and selling them for more than you bought them for. Everything you do should have a business mindset to it. You should not be doing random things. You should not be trading for entertainment. You should not be trading for excitement. You should be trading because you're bored. That's what gamblers do in casinos, and they lose money. Casinos have table limits to manage, and their customers are likely to risk it all. And you go in a casino, you can't go in a casino and lay down a bet and say, I'm going to bet your casino against this one roulette wheel roll. Casinos don't do that because that's the risk of ruin. While new traders do that all the time, where they're putting all their money into one trade and they could lose it all. And when you're operating as a casino, everything you're doing is systematically designed to make money from the traders that are gambling. That's the big difference in the profitable trader versus unprofitable traders. An edge, a system, a method, a focus, a discipline. Casinos have a mathematical edge and gamblers are at a disadvantage. They put green spaces on a roulette wheel to give themselves an edge. It's a small edge a lot of times in casinos. Everything they have in there, the house has a mathematical edge, however small. It would almost be like a trading system where your wins are $125 and your losses are $100, and you have about a 50-50 win rate. You're making money because you have a small edge in trading. The same thing with casinos. Their edge is small. Another edge that casinos have is even the people that make the monies gambling, they stay long enough that they end up giving it all back as the edge plays back out, or they start gambling too big. So, a lot of the same similarities with Gamblers Anonymous that have issues losing money, even though the edge is against them, and traders that just come in and they're letting their emotions and their ego and their drive them in their trades. Every trade you make should be a completely quantified business transaction with the odds in your favor. A casino has no ego or emotion, but gamblers do. A casino is just a mathematical model being executed. It's not a person. A casino is not betting against every single gambler in the entire casino. It's just simply a execution of a mathematical edge. Richard Wiseman's book, Trade Like a Casino, did a great job of explaining this paradigm in detail of how he's been able to make money, managing money for I guess over 20, 30 years. Richard Wiseman has been a successful investor. Achieving profitability. Profitable trading is simply a mathematical achievement. It's not really a stock pick or even a system or our decisions or predictions. It's really just math when you're a profitable trader. The best way to be profitable is to ensure that your winning trades are bigger than your losing trades. Avoid predictions or opinions and focus on the two aspects of a profitable system. Even with a win rate of less than 50%, you can still be profitable with big wins and small losses. More wins than losses if they are about equal in size. So you can make money by either having big wins and small losses, even if you have a low win rate, or you can have you can win more than you lose, but all your wins and losses have to be about the same size. If you have, the one thing that will make you unprofitable in any kind of system you try, any method you try, is large losses. Large losses it takes back your gains. It causes you to have drawdowns in capital. It's harder to get back up in capital. If you start with $100,000 in trading capital and you lose 50%, you go down to $50,000 in trading capital. You can't get back to even by being up 50% after losing 50%. It takes 100% gains to get back to even after you lose 50%. And that's a huge road to try to climb back up. Much is so crucial for everybody if you just keep your losses as small as possible. You want to exit trades when you've been proven wrong. Most of the way the big losses happen is when you get caught on the wrong side of a trend, where somebody buys a hot stock at 120 and they think it's going to go to 150, then it goes to 115 and 110, and then they think, oh, it'll come back to 120. It doesn't. It goes to 105, 100, and they just get stuck in it and hold it, and they're on the wrong side of a trend, and they end up losing a large amount of their capital. A stop loss isn't, so you can trade. You can trade without a stop loss, but you can't trade for a long period of time without a stop loss. Eventually, big losses will break you. If it doesn't break you financially, it'll break you mentally and emotionally. I've come back from drawdowns in my life, and it's very hard to start in the hole and come all the way back to even and then start making money again. The easiest path to profitability is to never have large losses. If you risk, see on here, if you risk $1 to make $3, or $1 to make $5, which in real trading would be like you're risking $100 to make $500, which is Paul Tudor Jones' favorite dynamic for profitability. You only need 17% win rate to be profitable. Even if you risk $100 to make $200, you only need a 33% win rate to be profitable. It takes a lot more pressure off of you if your win rate is smaller. If you have equal wins, equal losses, you break even at 50%. All you have to do is beat these win rates to actually be profitable. Of course, minus commissions and bid-ask spread. Sorry. This is like options are one way. Options are very small priced and they can be very big winners quickly. But this is the dynamic. You start risking $2 to make 100, you got to have a much higher win rate to make money. You start really getting ruined with risking $10 to make $1, which a lot of day traders do this. A lot of new traders do this, where they have very wide stops, but they have very tight profit targets. A losing streak can really hurt you very fast. The easiest way to make money is really try to get into this trend catching, where your profit target is 2-3 times as high as your stop loss is. This is really the best path to profitability from a mathematical standpoint. High win rates are actually in many ways harder than this, because even with high win rates, you got to keep your losses small. Big wins, small losses. Let's say we had 10 trades, and each trade we lost $100. 5 trades we lost $100. 5 trades we made $300. This is a 1 to 3 risk reward ratio. It's a 50% win rate. At the end of this, lose 100, make 300, lose 100, make 300, and lose 100, make 300. You end up making $1,500 in profits and losing $500 in losing trades. So your profit would be $1,000 with only a 50% win rate and a 1 to 3 risk reward ratio. A lot of traders and especially new traders and people that want to show up on social media think a high win rate is the key to profitability. Well, really it's the risk reward ratio is the key to profitability. You simply have capped your losses and left your profit sign open, you can make money. Of course, you need a trend, and sometimes you need volatility to make this happen. But this is just an example of the math of you don't have to be right every time. You don't even have to be right half of the time to be able to make money. This is a lesson that Paul Tudor Jones has stressed his entire career. Big losses and small wins. If you lose $1,000 on a trade, then you make 100, then you lose another 500, but then you make 200, 100, you make 100. It's just a big win streak where you're catching all these little small profits, 100, 200, 100, 100, 100. You end up making 1,000 in profits on all your small wins, but you've lost 1,500 in your losing trades, so you've lost 500 even with an 80% win rate. Just because you're right a lot doesn't mean you'll make money. If you allow yourself to have some big losses, you will not be profitable. This is just an example of what I'm trying to say in this part of the webinar. Is it's just crucial to keep your losses small. A couple of big losses, which some people listening to this may have that experience. A couple of big losses have cost you profitability. So that's another example of you've got to keep your losses small and consistent. All your trades should end as either a big win, a small win, or a small loss. You should eliminate big losses from your trading, and that'll dramatically help your trading regardless of what your method and system is or market. I was going to finish with golden rules for new traders. These are some things that can dramatically help your trading quickly. Never add to a losing trade. This is actually another Paul Tudor Jones principle. Is if you're losing money, you don't want to create your losing trade, make it bigger. Losing trade should be exited, not added to. I mean, and you can get away with it for a long time. You think you're dollar cost averaging, you're getting a better average price, but eventually with adding to a losing trade, you just get on the wrong side of a trend. That's like traders on the 1987 crash on Black Monday that kept adding to their initial position, and eventually a lot of people, with especially futures and selling puts, actually blew up that day. Or the internet bubble, where they were doubling down on internet stocks, they eventually blow up. I mean, you want to survive for long term, and one of the ways to survive is not to add to a losing position. You make a trade, and you're wrong, you admit it, you move on. You can add to winning trades. If you buy a trade, breaks out, it does great, it starts trending, and you can add early on. I've had to winning trades before, but not to losing trades. That's very counterproductive, and getting away with it and it working out for you is actually dangerous for your long-term survival. So I would strongly advise to exit losing trades, not add to them. This is not a good dynamic. Never lose more than 1% to 2% of your trading capital in any one trade. My biggest loss is if something goes really, volatility expands or something goes really wild, is 2% of my total trading capital. But I always strive to lose 1% or less. So if I'm trading with $250,000, I don't want to lose more than $2,500 on any one trade. And that's not a position sizing. That's where your stop loss is set. If I'm trading the SPY and I'm trading, I'll trade 50% of my capital, then our stop loss would be 2% because SPY is more smooth moving. So if I get hit on a 50% position size on my account with SPY and it goes down 2%, I will lose 1% of my trading capital. I never want to lose more than 1%. If you're trading at 10%, you're trading growth stocks and you're using 10% of your trading capital in a growth stock, it can still go down 10% and you wouldn't lose more than 1% of your trading capital. So this has a lot to do with volatility and position sizing. It's not saying you have 1% of your capital in a trade unless it's a option trade. It's saying that when your stop losses hit, you don't lose more than 1%. So if you're trading with $10,000, you don't want any trade to lose you more than $100 for long-term survival. If you lose 5 trades in a row, you're only down 5%. You can come back from 5%, 10% pretty easily. The main reason for position sizing is so you don't get yourself so far in a hole of losses that you can't get out of. It's really to minimize drawdowns. Never trade anything you don't understand 100%. It's not good to go into the futures markets or the options market or even the stock market if you do not understand how everything works. People get really hurt in low volume markets, especially penny stocks or low volume futures markets or options markets where the bid-ask spreads are so wide you lose a lot of money going into the trade and out of the trade. In a stock option, a dollar spread can be a $100 loss when you enter a trade for just one contract. So it's absolutely crucial. Don't put any of your money into any market until you completely understand how options work, futures work, stock market, forex, leverage, whatever you're doing. That's a wise decision to educate yourself before putting real money at risk. Trade in the direction of the trend in your trading time frame. That was important for after the election, where the U.S. markets and other markets just skyrocketed after the Donald Trump victory, where people that kept trying to short later on after the initial breakout really got hurt, especially ones that held their shorts, because those were some moves after the election were some unprecedented moves. I think at one point some stock indexes had 90 RSIs for the first time ever historically. But the time when something gets that starts running in that direction, so much momentum, you have to start buying dips and buying pullbacks and get on the long side. You can't keep shorting a market that was that powerful and that big of a breakout. So you want to trade in the direction of the trend in your trading time frame, and that has been buying dips for the last three or more months. Much easier to make money when you're going in the direction of the overall trend than trying to pick up pennies in front of a steamroller when there's a bull driving. So you just want to go in the direction of whatever your market's trending in most cases. Only look for low risk, high reward trades or high probability setups. When you don't have any signals, don't trade. You want to have, like, if the market's already down and far extended from its short-term moving averages, and it's still in a uptrend, a long-term uptrend, and you're buying a dip, like when a Dow drops 1,000 points in a day, it's a risk-reward setup where you buy, but you still have a stop. But the odds are within days it'll be back up to even with the volatility. But you want your stop loss to create a low amount of risk, and you want the potential for reward to be great before you even step in. And if the S&P 500 bounce at the 30 RSI intraday 70 of the last 80 times, that's a high probability setup. You want to actually be able to quantify, what's happened in the past when you're using technical indicators or price action. And if you don't have when you're looking for trades and hunting for trades and searching for trades, that's usually a bad sign there is no trade there. Signals should be clear, your system should be clear. Shouldn't be a lot of digging and looking and searching for trades. You have to trade your plan, your system, your signals, the chart, the price action, and not your opinions, bias, or predictions. So many great traders I know, they have bias. We all do. We all have things we think are going to happen, but that cannot be your trading plan. Your trading plan, your system has to override your own opinions, bias, and predictions. Because usually human nature is the opposite of what's going to happen in the stock market. Usually when everybody's most pessimistic and think the world's going to end, it's generally the best buying opportunity. And when people think the NASDAQ is going to go from 5,000 to 7,000, it's generally the top. Usually our first inclination is wrong. And it's important to have a planned system. Let a mathematical model do our trading, and let a written plan do our trading, not our own emotions and thoughts. We should have objective trading, not subjective trading. Finding a trading method that fits your personality. Some people are definitely not meant to sit at the screen all day and day trade, and other people can't stand no action and waiting for a trend to play out in the long term. But you got to find something that you enjoy doing, you like doing, you understand it. Some people don't even like holding positions overnight, and they're great day traders, while other people hate to miss the gaps, winning gaps in markets, so they like to be in all the time. Some people love to do stock picking and love to get companies that they love, that they're behind, and to just trade the trend in a winning stock. But if you don't enjoy what you do, you're not going to do it very long. So you have to find a trading methodology that fits your personality, that you enjoy doing. Don't trade before you have a complete trading plan, including rules on entries, exits, and risk management. If you do not have a trading plan, you should not be trading. You're not really trading. You're just doing random things and gambling for the most part. And you're going to get yourself into the 90% of traders that have a lot of trouble and lose money. You want to have everything quantified before you step in. Even if you're a discretionary trader, you need to have rules that keep you safe and keep you on the right side of trends and keep your risk under control. The size of your wins and losses determines your trading success. It's not stock picking. It's not even a specific system. It's the size of your wins and losses determines your trading success. The mathematical underlying of your risk-reward ratios, your stop losses, and how big your wins are. That's where you have to focus your efforts and study. Your risk management rules will determine the success of your technical trading system. It doesn't matter how good you are with your chart patterns, your technical analysis, your reading of what you think is going to happen next. if you risk too much money, you will eventually blow up. And you don't have to look any farther than the professionals. The Amaranth hedge fund blew up. Long-term capital management blew up. Victor Niederhofer, which had amazing record for so many years, he could have been a market wizard selling options. He blew up, I think, 2 times. There are Solomon Brothers. There's so many firms and hedge funds and new traders that have just blown up that your risk management structure you embed in your position sizing and your stop losses and your quantity of trades and how long you stay in losers and your discipline. That's going to override whatever trading system or method that you decide on. The risk management it's like the defensive side of your trading. It's like in football or soccer, you can score all you want, but if your other team scores more than you, you're going to lose. So your defensive game in trading is just as important as your offensive. It's important that you stop other traders from scoring on you as much as it is that you score enough points yourself for long-term viability. I think we are about 45 minutes deep, and that is what I had today. I hope that helps you in some way going forward. I tweet trading principles like we talked about here on Twitter daily. I blog on newtraderu.com. I go into depth on a lot of these concepts in my books. My books are available on all the Amazons around the world and on Audible, paperback, Kindle. They're actually even all on Kindle Unlimited, so you actually can, if you're a part of that program, you can actually read them for free. I know they got that in the U.S. I've got some e-courses I created, New Trader 101, Moving Average 101, and Options 101. They're on the website, and they go into these principles. They break them down into different 5-10 minute videos that explain each principle that we talked about today. And hope you got some value out of this and the principles I shared. And I appreciate you coming today, and appreciate Rainer. I really enjoy his Twitter feed. Rainer actually wrote 2 of the most popular blog posts in the history of New Trader U as guest posts. So he's done a great job, and he's built a great community, and I appreciate everyone for listening to the webinar today.
Okay, so thank you, Steve. Right, so for those of you who are new to Steve's work, right, I personally myself have gotten quite a number of his books, right, Moving Average 101, New Trader 101, and I can tell you that for the price you pay, it's a book, so it's not really expensive, right. There are a lot of timeless lessons that you can apply to your trading, so have a look at it, right. You can just go to Amazon, search for Steve Burns, and they will share with you the books that he has written so far. So right now, right, we're going to open the floor for the Q&A session, right? We'll try to run this for about 15-20 minutes. So for those of you who have questions for Steve, right, feel free to type it out, right? And I will, let Steve know what are the questions that you have for him. Okay. Okay, Steve, right? So we have a question from Ben, right? Steve, he says, what is the difference between trend trading and trend following? I think he's not too sure about that.
Trend following is really traditionally diversified futures where you have it requires a large amount of money, sometimes multiple 6 figures, where you diversify into up to 20 futures contracts. You have currencies, interest rates, even stock indexes, even different stock indexes. You'll be diversified across several different markets and sectors, and you're trying to capture a trend in one of those sectors. Well, each one of the position sizes are smaller over a long period of time, and it's almost all purely mechanical systems for trend following, diversified futures. But trend trading is more, you purchase one stock, one market, and it's not as diversified. You're just trying to capture a trend like a Priceline or an Apple or an Amazon, or even the stock market itself, like a 200-day moving average system. That's more of a trend trading. But the trend following system I showed you is something that could be inside of a trend following system. Trend trading more Nicholas Darvis, Dan Zanger, William O'Neill, Jesse Livermore. Trend following was more like Larry Hite, Michael Covell's books, and Andreas Cleno.
Okay, so thank you for sharing, Steve. We have another question from Ankit who asked, right, what's your time frame for swing trading?
I usually do swing trades between 3 to 10 days. I use usually in for opening day and end of day signals.
Okay, so let me look through the questions. We have a lot of questions, right? So I'm trying to pick the best one that could add value to the rest of the audience. Um, I think I have another questions, right? I think that is regarding exits. Let me see what is the specific question. Okay, it's from Chess, right? He asked you, right? Can you share with us some of the methods for exiting your trade?
Yeah, I like to, if I'm swing trading like a stock index, I like to exit. If I enter on the MACD crossover or I enter on the 30 RSI or even a breakout, I like to exit into around the 65 to 70 RSI, like overbought. I don't really like the risk-reward ratio in stock indexes after the 60, 70 RSI is reached. Other growth stocks, when I've traded in the past, Priceline, Apple, and so forth, the 10-day EMA is another one. I'll write a trend whenever one of these break out and they run so far, and I'll just let them run as much as possible, and I will exit on a trailing stop when it closes under the 10-day EMA, 10-day exponential moving average. So I have a overbought signal to exit, also have a trailing stop with a short-term moving average to exit.
Oh, okay, that makes perfect sense. Yeah, I think from what I noticed, right, Steve, based on following your tweets, your posts, I think you tend to look at the RSI. You pay quite a bit of weightage towards the RSI indicator between the 30 and the 70, as you've mentioned earlier.
Yeah, it works best in the Russell 2000 ETF and the SPY ETF too. Those are some of the best signals for those two markets.
Well, okay, yep. Thank you for sharing that. Okay, so let me see. Okay, so I think this is a quite should be quite an easy question from Sharaz who asks you, right, what is your favorite technical indicators?
He's moving averages. I love how it just smooths the trend and is able to trade a trend and even back test purely. I like moving averages even more than trend lines because you can 100% quantify a moving average. There's a lot of subjective opinions about trend lines, but moving averages are facts.
Okay, so we have another question, right? This time is from Kiza who asks you, right, how do you place your stop loss? I think this is something that would interest a lot of the people down here.
I have a mental stop loss. I don't physically put it in the market, and I try to trade a size where even if my stop loss is hit intraday, it doesn't cause me more than a 1% loss. So I have the luxury of an end of day stop loss. So if the SPY is at 33 RSI and I'll go in and buy it, and my stop loss will be a close below the 30 RSI, which is a very low probability event in the S&P 500. But I have my position small enough, so even if it plunges to the 28 RSI or 27 and closes, it's still going to be less than 1% loss. So I try to have a mental end-of-day stop loss and try to trade small enough so that unless something really strange happens, that I do not have to worry about getting stopped off intraday. But it's end-of-day mental stops.
Okay, I understand. Okay, right now, another question. This time, okay, this is from Harish, right? He asked you, right, what's your advice for beginners to start with? Should it be doing swing trading or day trading, right? So I think this is a question asking you whether should a beginner start with a day trading or swing trading approach.
Yeah, I would advise swing trading just for the less emotions and less screen time. I think day trading is a very emotionally and mentally difficult thing to do when you're starting out. I would definitely advise starting out with a slower system, a moving average system, swing trading, something of that nature. Maybe even a trend trading system where you're going to use this basic moving averages that you back tested. That might be the best way to start.
Yes, that makes a lot of sense. Uh, moving on, right? We have another question from Dinesh who asks you, right, Steve? He says, how do you manage to negate noise, right? Like for example, views on television, CNBC, Twitter and stuff. How do you actually get remove all this noise in your trading?
That took a long time. I think in around 2010 or 2010, 2011, I think I just turned off CNBC for the last time, and I did not watch CNBC anymore. I went to a quantified approach. I still had a lot of discretion, a lot of discretionary trading up until like 7 or 8 years ago. But yeah, I learned that I just look back at it. I never made money following the talking heads. A lot of them don't have real positions on, and they're just talking positions. And the news is generally discounted. If the news is already out, it's already discounted, and they're such a behind the curve on that. You almost make money at the system of doing the opposite of what financial news networks say to do for their market calls. So I actually turned CNBC off, and I went to a purely quantified technical trading system. So that helped me where I focused on price action and quit listening to any opinions or predictions.
That makes perfect sense. I think because I'm sure you can agree that sometimes, you get good news, the market falls, you get bad news, the market rise. How do you even make sense of, this kind of, action in the markets?
Yeah, I think last year, I think one of the big revelations of me was after the rally after the presidential U.S. election was I believe the market was going to do that regardless of who won, because the fear was so thick and so many people had exited, and the relief rally was so big that it didn't even matter who won the election. We were going to get that rally.
Yes. Okay, so let's move on, right? We have another question from Stewart who asks you, right, do you use candlestick patterns for confirmation?
Yes, not for signals, but for confirmation. The candlesticks is what my default setting is on stock charts, and I like the visual nature of them. And I will use like if I have a 70 RSI and a big reversal candlestick with a black candlestick or a just a tall tail candlestick, it will confirm my already signal and will give me a confluence of signals. Yes, but candlesticks are for confirmation, not for just a signal all by themselves outside of context.
Okay. So now I think we have another question from Gustavo, right? This one is a little bit more of your journey as a trader. He asks you, right? Uh, how did how long did it take for you to become a profitable trader? He asked you what is some of the crisis period that you had along the way, like overcoming your drawdown, the lack of confidence, the fear of losing and stuff like that. So basically, Gustavo wants to know, what is your journey like towards consistently profitable trading?
Yeah, I think I almost had I was too lucky too early during the 1990s. I thought I knew what I was doing because I was just buying tech, and I was almost more of an investor, just buying tech mutual funds and thinking tech was the future. And I did really, really well in the 1990s to the point where I had enough money to pay my house off when I was like 20-something years old. I thought I was a genius, but in reality, it was just pure luck, and I just happened to be in the right sector. So my education began during the internet bubble popping, and I had a 50% drawdown from my capital, my trading investment capital. So then I had to start back from scratch and had to learn from then on, and I really got deep in my education in 2002, 2003 after my 50% drawdown, and I was able to really inspire my education that I have today and really help me. And I got back to even around 2003. It took me a couple years to get back to even from the 50% drawdown, and to really start really having a good capital curve up until 2008. But it taught me in 2008 where when I started losing the momentum and the moving averages were lost, I actually avoided the 2008 crash because of my 2000 experience, and I had a positive single-digit year in 2008. Which was, for me, a huge win with what I saw going on around me. So my risk, really the education on risk that I have to this day comes from my pain I suffered in the internet bubble collapsing. And I was very fortunate I didn't lose more than a 50% drawdown during that time, that I had actually started using more price action trading. So yeah, risk management with my education. I really have been very, very consistent since about 2003 after my first success. And I had a steady equity curve and done much better since that. But yeah, risk management, it was really my key lesson in my journey.
Wow, okay. Thanks for sharing. I think a positive year in 2008 would be, the envy of many out there, those who lost everything and all the ugly things that happened. Boy. Okay, so moving on, we have another question asking you. Okay, let's see. When do you? Okay, this is a question from Viral who asks, do you enter your trade on the close or do you wait for the open on the next day?
Yeah, I typically do. I do both. Primarily during a solid trending bull market, I'll do end of day positions for the most part. But I trade the first hour of the open and the last 30 minutes of the close. And if I do get if I have a good signal I'm waiting on, I will at times do an intraday trade. But I'd probably say 80% of my, well, probably, yeah, about 80% of my exits are end of day, and about 20% of my entries are beginning of day. I try to primarily do the open and the close.
Okay, yep, that makes a lot of sense. Uh, right, next question from Kumar who asks you, right, they say there's so many, hundreds of stocks to trade out there, right? How do you actually screen for the setups that you're looking for?
Yeah, I try. I really have a watch list where I prefer. My whole career, I've never traded more than 5 to 10 stocks at any given time. The Can Slim growth system is the best system for filtering for fundamentals, so you know what to trade. I don't trade with fundamentals, but I have a watch list based on the best stocks. Like a really in this day and time, we're in the middle of the aggregation of information age. We've already gone past information age. The stocks that have done the best over the last 10 years have been ones that aggregate information. Google aggregates search, Priceline aggregates travel data, Netflix aggregates television, Apple creates the hardware for aggregation. So I think a good watch list would be those companies that are aggregating information and changing the world, which that's what has performed the last 10 years. And Amazon, aggregates retail information. It's the biggest search engine. But what you do is have your watch list of those 10 most powerful stocks, and then you would wait till one of those had setups. I do not believe in scanning through the entire universe of stocks for a setup. I would prefer to have stocks that I've studied the charts and I know the underlying company itself is strong, and then I would trade the price action, which is what the Can Slim method is. I mean, it's not it doesn't do as well as it did in the past with the speed of the market nowadays, but I would advise getting you a small watch list of the best stocks and then finding the technical setups on those.
Okay, that's a brilliant answer. Okay, I believe that answers uh, the question. This time round, a simple, straightforward question from Ellen who asks you, right, what is your RSI settings?
It's the default 14.
Okay,
That's what everybody's looking at.
okay, the default 14. Okay,
14.
okay, okay. A question from Bay who asks you, right, do you hedge your portfolio? Like, for example, you take a short trade when the index is bullish and, stuff like that?
Do I hedge my portfolio?
Yes, that's right. Ask you whether you hedge your
Yeah.
portfolio.
Yeah, I don't have really a portfolio. I have trades, they're just all independent trades, and I do not do the hedging, which I know Tom Basso loves that, where he hedges with SPY short. He has underlying stocks, but at this point, I haven't really had a portfolio in years. I really do just individual trades.
Okay, yep, that makes sense. Uh, let's see, right? Another question from Adele who asks you, right? How do you know when a strategy is profitable? Is backtesting 100 trades enough, right?
100 trades would give you an idea, but I think you have to go through markets. You have to test any system through a bull market, a bear market, and a sideways market. In the book I had, How to Beat Buy and Hold, I took the moving average systems and I showed you what it did during a sideways market, a bull market, and a bear market. And a crucial thing is you have to look at what happened on Black Monday, October '87, and you got to look at the internet bubble in both directions and the 2008 crash now and see, because that's where you'll see if you even might have blown up at those points in time. Whenever I start a system, I go to the 1987 Black Monday, the 2008, and the internet, and I also back test during like the sideways years and the bull market years and the bear market years. So you got to have a type of market you need to look at as well, especially with volatility expansion. That really can change the system's dynamics.
Okay, so basically you're saying to test the system in different market conditions, bullish, bearish, range bound, trend, and
Yeah.
all the different market conditions.
Yes.
Okay, so okay, we are pushing a little bit. So let's answer another three more questions before we let Steve off. Right. The final third question for you, Steve, is by Subdo, right? He asked you, right, as a trader, we all have periods when it's tough and where we feel that we can't make it. So how did you actually get over this process?
And it takes time. You can build confidence when you have the winning years. Once you have that, that can give you confidence forever. When you know you've done certain things over a 4 or 5 year period, you know you can do it again. You have to have the confidence in yourself, which comes from the winning. But at the same time, you can have confidence in your system. Before you make any money, you can know, the stock market for me over long periods of time goes up. I just have to participate in that going up. And I've back tested certain systems. And, when we come out of I have a signal that I know, that like the QQQ 250-day example, if you're sitting in that and your price breaks over your 250-day, eventually you're going to catch a 30% move in the Qs. So you can have confidence in your system that you back tested, the data yourself, but you got to have confidence in your system. It only comes from back testing and knowing and doing your homework, and eventually you'll have confidence in yourself once you put in the time and have those winning years.
All right, that's brilliant. All right, well said. Totally agree on that. Second last question. Okay, let's see. It's a good question, right? By Agus, right? He asked you if you could go back to your first years of trading, right? What are the things that you would be doing differently right now?
If I would have been able to start back at the beginning, I would have started with a quantified system, quantified moving average system from the very beginning, and I would have not really gotten as much discretionary road, which I was fortunate to get on the right side of a bunch of great stocks and made choices, and a lot of it was luck at the beginning, but I wish I would have removed the luck from the equation and really just gone with some quantified moving average systems from the very beginning and saved myself a lot of stress and grief and drawdowns. So I would say quantified systems from the beginning. I would have managed my risk much better with less risk exposure from the very beginning. Would have done a lot more homework before I ever put any money at risk.
Okay, thanks for sharing. And for the last questions for the last question for tonight's webinar, right? Let's see. The question is, okay, it's by. Okay, what's this? It's by Etish, right? Who asked you, right? Is there a market condition where price action don't work, or is it that price action works in every market condition?
Yeah, different trading methods work in different conditions. The hardest condition is volatility. Most day traders can do well in volatility when it swings wildly in a day. But even then they can even get on the wrong side of it. But really volatility, the higher volatility gets, the wider the price range. For most systems, that generally becomes the hardest time to trade because it almost becomes random in nature and triggering entries and exits and stop losses too fast. So I'd say intraday volatility, the higher it gets for most people, the harder it gets for most systems to work right.
Okay, so thank you for your answer, Steve. And yep, right, that's all we have for you in tonight's or today's webinar. I hope all of you found this useful, and I want to thank you, Steve, for your time, right, to present such valuable information. And once again, for those of you who want to reach out to Steve, this is his Twitter handle, and this is his website, right? This is where you can connect with him, right, and learn more about his works, right? So go for it, right? I'm really following him on Twitter. If you guys are not doing it, you're doing yourself a disfavor. So just go follow him on Twitter and reach out to him at newtraderu.com. Right, so Steve, any final words for the rest down here?
I appreciate you having me, Rainer, and I wish you all success in making money. And thanks for showing up today and let me go over this with you. I appreciate it.
All right, you're welcome, Steve, and I wish you a great day ahead.
Thank you.